It's official that the Silicon Valley Bank has become a bailout situation. And many of you may be questioning, is that a good thing or not? And why do they even need a bailout? In this video, I'll go over the action taken by the Fed, and then I want to answer a few questions such as, what happened to Silicon Valley Bank? How did this bank fail so fast? What does this mean for banks, and should I be worried about my money? Which stock will be impacted from this news? What does this mean for interest rates and the Fed? And is this bailout a good thing or not? For context, Silicon Valley Bank collapsed on Friday, March 10th, and is the second largest bank failure for the US at $209 billion in assets. And if you're not aware, Signature Bank was also closed on Sunday, the 12th. And that happens to be two banks in just a couple days. And there's also speculation that San Francisco's Republic Bank is also at risk. And I'm sure we're all going to find out soon enough. So what is the impact so far from the collapse? For the everyday consumer with less than $250,000 in their accounts, they'll be fine where the FDIC insurance is going to kick in and they're going to get their money straight away. Where it gets sticky is that there's several large companies that banked with Silicon Valley Bank where they kept a portion of their cash reserves in things like payroll and expenses, and that happens to be millions upon millions of dollars, where those funds are not going to be covered because they far exceed that $250,000 threshold. And you might be wondering, how much exactly? Well, Silicon Valley Bank had about $175 billion, or 85% of its holdings, that weren't covered by FDIC. As for the impacted companies, here's a list of what was lost on a handful of those companies. Roku, $487 million, Rocket Labs, $38 million, Roblox, $150 million, and Circle came in at a whopping $3.3 billion. And then there's also Lending Club at $21 million, which is just 0.2% of their holdings. That is a lot of money that all of those companies are going to lose because it's not insured. But if you weren't aware, it was just announced from the Treasury Secretary, the Fed Chief Jerome Powell, alongside the FDIC Chair, that they stated that all depositors will have access to all their money on Monday the 13th, officially making this a bailout situation where all the depositors that were not insured are now going to have access to all their money. In the announcements, it was stated that it has no taxpayer impact. Instead, this is going to be subsidized by placing a special assessment on other banks. And there weren't many more details over and above that, but if you think it through, if banks are assessed a fee to help pay for this, then a person may also come to the conclusion that banks will need to then recoup those fees from its customers. It sort of seems like taxpayers will still be paying for it. Just my opinion. Let's move on to the next question. What exactly happened to Silicon Valley Bank, and how did it happen so fast? A typical bank has a diversity of customers across both its retail and its commercial side of business, but that's not true for SVB. Given their location, they specialized in venture capital and funding startup companies where the payoff can be extremely high, but the losses can be equally as high. Where roughly 85% of the capital at SVB was not insured, but the atypical bank has about only 25 to 30% that's not insured because it exceeds the $250,000 insurance limit. This obviously compounds the risk for Silicon Valley Bank, and they also made the mistake of purchasing mortgage-backed securities last year worth about $80 billion. And I'm sure that it seemed like a smart plan up until the point when the Fed began to increase its rates and completely undercut those mortgage-backed securities. The higher rates from the Fed resulted in the return on government bonds going way up to nearly 4%. But the mortgage-backed securities that Silicon Valley Bank invested in only had about a 1.9% return. In general, the market chose to buy safe returns on government-backed bonds with twice the return, and that caused SVB's value to take a major nosedive. And as this is happening, many of the tech startups that make up the majority of SVB's clientele were hitting major headwinds, and they began to withdraw their funds just to maintain their business. SVB leadership recognized that they quickly needed to increase their liquidity to meet the needs of their clientele. So they made the decision to sell a portion of their portfolio at a loss of $1.8 billion, and also to sell a ton of their shares on the market. Keep in mind, this is all happening while FTX completely collapses. Then there's the fear of the economic recession, and then tech companies are on a layoff spree. Add all of these things together, and SVB was hemorrhaging money. No surprise that all of its customers became scared and all rushed to withdraw their money, resulting in a bank run, and the SVB losing $80 billion overnight. And just like that, they went belly up, and the FDIC took over the bank in one day, and a bailout was announced a couple days later. To summarize the major causes in SVB failing, it really comes down to the Fed increasing its rates so rapidly, an overabundance of clients in one specific sector, tech, which has been falling on hard times, and then there's the human fear causing cash withdrawals. So what does this mean for the banking industry, and should we be worried about our money? Given that Signature Bank just failed, I can't state that this is a one-off situation. Thankfully, there are a few trends that are tied to both SVB and Signature Bank that really set them apart from most all other banks. Silicon Valley Bank was hyper-focused on tech companies and startups. It's investment 101. You don't put all your money in one basket. And as for Signature Bank, they were one of the few institutions that allowed for deposits of crypto assets, which really came back to bite them. Once FTX failed and the bottom fell out on crypto value, Signature Bank was also in a hole that it could not get out of. But this is good news for the rest of us, because there are underlying reasons why they failed. They are not like atypical banks, and their leadership teams did make some fairly poor decisions. Like the fact that SVB had given out bonuses to its employees just days before they collapsed. Some people have speculated that SVB wouldn't have collapsed if it weren't for all of the customers going into a panic mode and making a bank run to withdraw all their money. And in some ways, I think that there's a little bit of truth to that. Me personally, I want to instill calm and sensibility about what happened, because I believe that the last thing that YouTubers or media should be doing is embellishing in fear just to make money, because that's only going to make the situation worse. I happen to be optimistic that these banks failed for specific reasons, and I don't see a reason for major concern across the entire banking industry. Now on to the next question of which stock or funds will be directly impacted from this bailout. I think it goes without saying that anyone that held Silicon Valley Bank stock, well, they're going to lose a lot of money. The bailout is only specific to the depositors of the bank. Sadly, it does not provide any assistance to the investors. And that is the risk of investing. And here's a list of the top ETF that will be impacted due to their holdings in SVB. These were just a handful that had the largest holdings of Silicon Valley Bank, but there are many more with smaller holdings that a person can quickly research online. As for the specific stock, most all of the bank stock are going to be taking a hit in the short term, but that is based mostly on emotion and not performance. A lot of solid investors are going to take advantage of that emotion and they're going to buy the dip. And no, I'm not recommending that, I'm simply stating what I believe is going to be the case. On to the next question of what does this mean for the interest rates and the actions the Fed takes? The current trajectory from the Fed was leading us all to believe that in March they were going to raise rates by another 0.5%. But given the need to create stability in the banking industry, I fully expect that the Fed is only going to increase its rates by 25 basis points. All pure speculation and opinion on my part, but I believe the economy can't take another hit of anything above 0.25%. But we're all going to find out soon enough. And the last question, is this bailout a good thing or not? And I am not a huge advocate of excessive oversight, but in this case, I believe that the bailout is necessary, simply because of how many companies had millions upon millions of dollars tied up with Silicon Valley Bank that would have been completely lost. The impact from those companies losing that amount of money would have created a downward spiral across the entire tech sector, resulting in a massive hit to the market, the crypto markets, and really creating a lot more public fear. Our banks, our markets, and our economy need stability, and I believe that a bailout is going to be the best way to ensure that stability. But let me know in the comments below if you think the bailout is a good thing or not. And that wraps up today's video on Silicon Valley Bank and the bailout. Thank you so much for watching.